Before you invest in any stock, do you ever think of the effect that foreign exchange changes have on your overall profit? I'm guessing for most of you, the answer to that question is probably not. Here is just a quick example from my own investments that will show you the effects that FX can have on your profits. So I invested in IBM back in March 2020. I just bought 2.5 shares. And at that time, the share price was $104. So in March 2020, the euro would get you $1.10. But since then, the dollar has been seriously devalued. So it has gone from the euro buying $1.10, but now a euro will actually buy you $1.20. So to see the effect that this has actually had on my investment, so my overall gain or loss in US dollar terms was 40.49%. But when you take into account the movement in the FX, my return is just 28.15%. So the FX movements knocked a good 12% off my returns. So is there anything that we can actually do to hedge against these FX losses? What I am going to look at in this video are 5 different strategies that you can use to minimize the effect of FX losses on your overall investments. The first of these strategies on the list may not sound like much of a strategy, but hear me out. So strategy number 1 is to do nothing. The view that this strategy takes is that currency fluctuations over the long term tend to cancel each other out. And we have a lot of historical data that will back up this view. But the time frame you are investing over has a huge effect on how successful this strategy is. Let's have a look here at an example for the GBP USD exchange rate. The graph shows you the annual change in the GBP USD exchange rate if you had invested over 1 year, 5 years, or 15 years. If you look at the red line on the graph, this represents anybody who just decided to invest for 1 year. And you will notice that this line on the graph is far more volatile than the other two, which are the 5-year investments and the 15-year investments. So the longer that you invest for, the less and less impact that the currency fluctuations actually have on your profits. You will be able to even see this more clearly on the next table I show you. So for anybody who decided to invest for a minimum of 1 year, they could have had a loss of up to 31.6% due to FX, or they could conversely have had a gain of 41.8%. So there's a massive swing and differences between what the maximum and the minimum FX effect on your portfolio could have been. But now if we move up to 2 years, you will see that there is far less currency fluctuations. So the minimum here in this case is 14.4% and the maximum is 10.2%. And then if we push it out further again to 15 years, we'll see that the currency fluctuations have a very small impact on your overall investments. The most you would have lost on FX is 3.8%, but you also could have gained on FX of 2.8%. What this all means is if you plan on investing in foreign stocks for a period of say like a month or 6 months or a year, then you need to be thinking about exchange rates. But the longer the time frame that you invest for, the less the effect the FX will have on your overall returns. Strategy number 2 is to spread out your stocks across multiple different countries and currencies. When you think about it, you wouldn't allocate all of your capital just to one stock. Similarly for currencies, you shouldn't hold all of your investments just in one currency. The tendency for most investors is to buy stocks in the likes of Google and Apple and other large US companies. But the more and more US companies that you add to your portfolio, the greater exposure you are going to have to fluctuations in the US dollar. One logical way to avoid this is obviously to spread it across multiple different regions. For example, you could have 30% of your money invested in US companies, another 30% invested in EU companies, maybe 20% invested in UK companies, and maybe another 20% invested in Asian companies. But if that is something that you would not be willing to do, don't worry, we have a few other strategies to go through that might be more suitable for you. Number 3 on the strategy list is using CFDs or contracts for difference, or also spread betting. CFDs are derivative products that allow you to speculate on financial markets such as stocks and Forex. I will show you an example in a moment, but one useful but also dangerous part of trading with CFDs is you can often trade CFDs on margin. What this basically means is you only have to put up a small portion of the investment to be able to invest with large sums of money. So just a further disclaimer on CFDs, so they are very risky, so you need to really understand how they work before you ever would consider investing in them. I'll show you where you can find them now on Trading 212 and also tell you about some of the downsides of using this method. So I have just come over to my Trading 212 account here. When you first sign up, you will just get the normal investing account, but you can also get an upgrade to a CFD account by just answering a few questions and making sure that you understand CFDs first. So I'm just on my CFD account here, and I will show you how to use CFDs to hedge against FX losses. So it's very easy to do. All you have to do is come over to the FX banner on the left hand side here. I've just selected FX, and then you're going to look for the currency pair that will give you some hedge to your exposure. So if I have all my stocks in USD, I want to hedge against the US dollar falling. So in that case, the currency pairing I'm going to be looking for here is Euro USD. And because I am worried about the US dollar falling, what I'm actually going to do is sell US dollar and buy Euro. So it starts off with a minimum investment amount of 500 Euro, and it goes up in 500 Euro increments. So you can invest 500 Euro, 1000 Euro, 1500. The important thing that you really need to know is the margin that you are actually trading with. So as I was saying before, you only put up 500 Euro, say for example, and this allows you to trade with a much higher amount. So to work out how much you will actually be trading with, really, if you come to the information section on the currency pair, and then if you scroll down here to the bottom, you will see that it has a margin of 3.33%, and it also says here leverage of 1:30. So if you're investing 500 Euro, you're really going to be investing with 15,000 Euro, which is your 500 Euro multiplied by 30. On the one side, this is very good because you only have to put up, say, 500 Euro to hedge your FX risk. But on the downside then, let's say for example that instead of the US dollar actually decreasing in value, it increases in value. So your stock value actually increases and your CFD decreases in value. And if it decreases enough, you will get margin called, and you will have to put in extra money to maintain that margin that you have there on the investment. And this would be a bit of a pain if you don't have any cash laying aside. So you would have to maybe sell some of the gains that you've made on FX on your stocks just to repay the margin on the CFDs. So it's a little bit awkward if you don't have a bit of cash on the side to maintain the margin if it goes that way. The fourth strategy on the list are currency hedged ETFs. This strategy might really suit anybody who regularly invests in index funds like the S&P 500. So let's say for example you are somebody in Europe who invests in the S&P 500 regularly and you are worried about the US dollar weakening. You've actually got some very simple ways that you can hedge against the US dollar weakening. There are special types of ETFs that build in a hedging element that protects you against any falling dollar. I'm just going to take you over now to a very useful website that you can use to find the likes of these ETFs that are already hedged. The website is called Justetf.com, and I'm just going to go over to it now and have a look at it. So I'm on the homepage here. So this website is basically a screener that you can use to filter out the types of ETFs that you want to actually invest in. So if I wanted to find ETFs that are hedged against the US dollar falling, all I would have to do, say for example, is just select on the equities tab here, and then you can further filter it down at the bottom section here. So there's loads of different ways you can filter the list of ETFs. So I'm just going to filter it by currency. So if you see currency hedge here and you select Euro hedged, there's 68 different ETFs there in the list that are Euro hedged. So that means your value of your Euro is protected. And then there's a big list, and you can scroll through and see which ones are best suited for you. If you invest in the S&P 500 or the FTSE for example, there's different options you can choose there. The last strategy I have on the list here is my least recommended, and that is finding out undervalued currencies and buying them. So this would be seeking out different currencies that you think have a potential to increase in value against other currencies in the near future. So you might decide at a particular point that the Japanese yen is going to appreciate against the US dollar, and so to protect your investments you would buy some Japanese yen, and the appreciation of the Japanese yen would offset your losses that you would make on the US dollar. But for me, there is a lot of work involved in this type of strategy because you need a bit of an economics head on you. You need to be looking at the likes of trade deficits, inflation rates in different countries, and also looking at a lot of data such as the value of goods exported and imported into the different countries. So for me, this is definitely the least exact method of going about hedging your FX risk. But I would love to know what you guys think. Is there any of those strategies that you have put into action yourself? Or if you have any other strategies that you use yourself, please let us know in the comments so we can all learn from each other. So thanks very much for watching everybody. I hope you enjoyed the video, and if you did, I would really appreciate it if you subscribe to my channel and like the video to help me get this out to more people.